Welcome to the Same Day Podcast, where we discuss driving incremental business growth and other topics related to real estate, property management, and entrepreneurship. Now to the show at hand.
Matt Zalk here. I'm the host of the Same Day Podcast, where I connect with top business experts and real estate leaders. Some of the past guests that we've had on the podcast include Vondell Burns of Thankless Productions, Aaron Wiggum of New You, and Brooke Reuter talking about contract for deed versus lease to own options. A very interesting podcast. That's a very nuanced distinction, but important for our investors to know and learn about. Today's episode is brought to you by Chris Lyle State Farm. Chris Lyle State Farm helps you protect your most precious assets and investments. Whether it's your home and auto, investment, rental properties, or other valuables, call Chris Lyle State Farm for a quick and painless phone call to potentially save you double digits on all of your insurance needs. Visit Chris at diallyle.com. That's DIALLILE.com, or call his office at 918-878-7771. He's licensed in Oklahoma, Arkansas, Kansas, Colorado, and Texas. So he can do a bunch of different properties for you, or anything else that you've gotten in other jurisdictions. Today's episode is also brought to you by Keyrenter Property Management. At Keyrenter Property Management, we are a full-service property management company helping our clients buy, renovate, and operate real estate assets. We help our clients build wealth while taking the headache out of property management. Caleb, you probably know this as good as anybody else, but it's hard to line up contractors for make-readies to do them in a reasonable amount of time after a tenant leaves a property. Contractors are busy. The work seems to drag on forever, and all that leads to lost rental income. At Keyrenter, we line up our dedicated vendors so that turns can happen super quickly and we get more money back in the pockets of our owners. And that's why no matter what rentals you have, single-family homes, condos, townhomes, apartments, we have the management solutions that you need. Go to KeyrenterPMC.com or info@KeyrenterPMC.com. Caleb Caldwell is our guest today. So happy to have you on. But I want to say before we get started,
excited to be here.
You and I met at BNI, Business Network International. It's a referral marketing group where where one professional classification has a single person representing that classification in each chapter. And we pass referrals back and forth. It's a group of folks that we know, like, and trust, and therefore feel confident passing those referrals back and forth. Great. It's a great chapter. We have Green Country Business Alliance here in Tulsa, along with a bunch of other chapters. But I think that's a very valuable, I've been a member for 5 years. It's a very valuable group focused on, passing referrals and making money and growing your business. So super thankful to BNI for doing that. But before we get started, let me introduce you. Caleb's a partner at CCK Strategies, a public accounting firm. He works with entrepreneurs all across the United States and even in several jurisdictions worldwide. He's the youngest partner at his firm. So you know that he works hard, and he'll work hard for you. I know that to be true because I work with CCK, and I'm going to tell you a little bit more about CCK. And then Caleb, finally, after all this, I'm gonna turn it over to you. I think it's worth noting, full disclosure, Caleb and I work together. Caleb is our CPA and strategic advisor for both Keyrenter and also for our family. And it's worth noting that he's not the cheapest in the room, but my perspective has always been, you get what you pay for. If you're listening to this and your first thought is, I want to have the cheapest way to file my taxes or prepare my 1065s or whatever you need from a CPA, I don't think CCK is the right fit for you. You probably don't even need a CPA. You might just have a tax preparer, who's going to be cheaper and will do what you need to do. But, CCK really is a strategic advisor rather than just a public accounting firm. And what I love about Caleb specifically at CCK is that when you call, he answers. And if he doesn't answer, he sends you a quick text that says, I'm in a meeting, but I'll answer you, when I can. And that's super important to us because we have these complex tax issues. We have clients that have, questions about tax, and I can always get Caleb on the phone with a client to say, hey, this is what we're working through. And this is what I need help with your thought partnership on at the moment. They provide strategic guidance on rental portfolios, depreciation, 1031 exchanges. And in addition to that, when I was looking for a CPA, I wanted somebody that was relatively my age that could grow with me for the next couple of decades, that would know my history, know my goals. Right. And with CCK and with Caleb, that's what you get. So they stay up to date on tax regs and best practices. And so, I think worth just mentioning all that beforehand. But if you want the cheapest solution to, just filing taxes, go to your local tax preparer who can just put all the numbers together and they'll get that done. So with that, having said all that, Caleb, welcome to the show.
No, thanks, Matt. I appreciate that. Your introduction was great. kind of to your point, on the you get what you pay for. What I always find interesting is, if you're only looking at your cost and not what you're getting out of it, then you're misguided. So really, you should be looking for a value proposition. So what are you getting out of it? Who cares what the cost is, as long as the value way outweighs the cost.
Totally. And I think that's
I love it.
huge
Appreciate
portion.
you having me today, by the way.
Thank you for being on. I appreciate you. A huge portion of what a CPA can do is saving you money in, finding unfound savings, right? That's depreciation. That's costs. Is it a cost segmentation or cost segregation?
Segregation. Yeah, cost segregation.
Yeah. So,
and then, obviously credits, things like that, it's just really trying to understand what the whole picture is and what all the opportunities are. And as long as you're up to date on the law and what it says and what it doesn't say, then that's where you look for opportunities. And
I don't know if we'll have time to touch on that today, but I mean, you guys have brokered in the past. You've had clients that were trying to sell tax credits, and you guys have brokered those tax credits in the past. I've never bought those, and you and I have talked about them a bunch, but I have never had a need to buy those. But I know that you guys have done that in the past, which is a very valuable, intermediary role played kind of in the market. If you're looking to buy tax credits, CCK can help you do some of that. Let's go all the way back to the beginning. Like what got you into public accounting?
It's kind of a funny story. I don't really have any family members or anyone that's in this space. I went to college and I said, I guess I'll do this accounting thing. And, I just kind of like I do everything in life. I hit the ground running as hard as I can. And fortunately for me, I never had to look back. And I'll say stumbled across CCK one day, and I interviewed for them, and I remember thinking there's no way they're going to hire me. And then here I am, almost 10 years later, and I'm a partner at this firm. And I actually remember asking one of the partners who hired me, why'd you hire me? And she said something along the lines of, we don't really know. We just had a feeling. And so I think I kind of had a feeling, and sometimes life works out that way, and I feel very fortunate. Yeah.
It's funny. When I was at Georgetown, McKinsey and Company, the consulting firm, came to recruit, and they were at the Ritz-Carlton, and somebody, it came to me through a friend that they were hiring, that they were, doing this information session. And we went to the information center, and walking away, he said, they're definitely going to hire you. And I thought, that doesn't make any sense. Like that place is way too fancy for me. The Ritz-Carlton, fancy business cards. I don't think that'll be the case. And ultimately, I went to work for them for a bunch of years. Sometimes it just, you don't know why, and they don't know why, but they see something special, and it all works out for the better. So good for you.
Well, you can't really measure chemistry, and sometimes you just have that chemistry, and you don't really know what to say about it. You just move on.
Sometimes it's just about core values, alignment.
Right.
A ton of our clients ask us questions about real estate and tax.
Sure.
They love real estate for the following scenario. I've got a day job. I've been investing in my 401k, but I want something that can provide greater returns than the stock market's 12% average over the last, 100 years or whatever it is, with less volatility. And as we've seen, we're recording this on the 6th day of October. There's been huge swings. We're potentially going to go to war with Russia. There's been huge inflation. The Fed's been raising rates. It's been crazy. And they want something that's not so volatile. They want to make money in a bunch of different ways, and real estate helps them with that. There's cash flow, there's appreciation on the asset, there's principal pay down. It's a hedge against inflation as you kind of long-term inflate your debt away. And then depreciation is a huge one. They want to offset their accounting losses against other gains. My question is, and I always feel like I'm in the holy grail situation, because I buy real estate, I've got the depreciation, the accounting losses, and I can offset that against other active income, my W-2 from the company. So I guess my question is, what do you need? What does somebody need in order to have active losses in real estate? Because of course the passive loss is, I'm a doctor.
Sure.
I make money in the stock market. I've got passive gains, and therefore my passive losses have to offset those passive gains. But if you want to have active losses that you can, offset against your W-2, what has to happen?
Sure. I mean, I'd say the hardest threshold that I see clients facing on that exact question, Matt, is related to this 50% of your work activity. So the way to qualify for an active real estate professional, over 50% of your working hours has to be involved in real estate activities. That doesn't necessarily mean you're the property manager and you're on site every day. It can mean you managing your property manager. It can mean, you doing all the back end accounting on your own. I mean, it can be you out marketing a property for rent. I mean, all of these various activities that adds up, and you start counting the hours. Okay, how much time a week am I spending on real estate? How many hours a week am I spending at a job? So the IRS loves when you have a full-time job, 40 plus hour a week, and you've got this huge W-2, and you also are trying to take losses, because that's a real red flag for them. So I'd say really, managing that with your CPA and understanding, okay, what are you doing as an individual, and also what's your spouse doing? Are they working or not too? And what opportunities might arise from that to be considered an active real estate professional? That in a long way of saying, that's how you get to deduct active losses, how you get to deduct real estate losses against your other income.
Okay. And if you don't qualify for that because you work in tech sales, for example, and you take all these losses, you harvest all these losses, or you not harvest, maybe is the wrong word, but you have 5 years of accounting losses. Do those expire? Do you need to use them by a certain point? Do you just lose them if you don't have $1 million in stock exchange gains and dividends that year, or how does that work?
No, it's a great question, and there are a lot of nuances to this. So certainly, if you've got multiple properties, talk to a professional about this stuff. But what I'd say in general here is, if you've got a loss on a rental property, year over year for tax purposes, because we're depreciating the fire out of it, we don't want you paying any taxes on it. So those losses will actually carry forward until one of two things. One being you sell the property. So whenever you sell the property and you've got a gain on that sale, you get to use these, they're called suspended losses. So you get to use these suspended losses against that gain. The other way that you can free up or untrap those losses would be simply by generating income. If year over year, you've got this house and we've depreciated it and you've held on to it for 15, 20 years, and the depreciation's this big. You've got a nice house, so you're not having to put a whole bunch of money in repairs and things like that on, so you actually start generating income.
Sure.
Well, if you have all these losses from, say 10 years ago, that's the nice part about that is now that you're generating income, you're slowly untrapping those losses, so you're still paying no tax on your income. And so it really is a good method to use.
Is there a spot on your tax return where it says, suspended losses, or all the previously held losses? Or just one number that just starts to whittle down? It was previously $10,000 of losses. Now it's $9,000 of losses. Cool.
Yep. There are some passive activity loss worksheets, and it should be in just about every tax return as long as you have that. So certainly look for that form.
Cool. Let's talk for a second about 1031 exchange. We've had a lot of guests on the show that have talked about 1031 exchange and how beneficial it is and how it creates generational wealth. And it's the fastest way. I mean, it's an incredible way to capture upside of a hot market and avoid paying, long-term capital gains as long as you've had the property for more than a year. Tell us about the deferred exchange. What is it and why is it helpful?
No, great. I'm glad you said it that way. I was going to start with what is a 1031 exchange, and it's a little bit different. So for you investors that are listening that have been in this game for several years, pre-Trump tax cuts, there was an opportunity to have a 1031 exchange on several things, personal property, et cetera. Nowadays, just to keep you in mind, we're only talking about real estate. So real property is all that you can do a 1031 exchange. And what that is simply if you own a piece of real estate and you sell it for a gain, as long as you meet certain criteria, which we'll talk about here in a second, then you can defer that gain into perpetuity. So if I sell a property, say for $100,000, and I go and buy a new property, as long as I fit the criteria I'm going to list, then you don't pay any tax on that gain until you sell the new property that you bought. Which then, to your point, Matt, about creating generational wealth, that's a great way to continue to defer it. So as long as you keep buying new properties with each gain, you can do this forever. We just have to make sure that we're buying properties that are worth more than what we sold.
And real quick, if it's purchased in an LLC, does that deferral stop when you die? I mean, is it just you have a step up basis when it passes through to the next person, or if it's an LLC, it's an entity, and therefore the entity never technically dies?
Great question, Matt. I can tell we've been working together for a little bit here. So, the beautiful thing about real estate, so is if you pass, and again, there are nuances to everything I'm going to say today, guys. So I'm going to give you some general information. But if you pass, and say it's in an LLC or not, Matt, either way, when you pass, your heirs, they'll inherit that property at fair market value. So they get what's called a step up in basis, which means it just goes right back to what it is as of the date of death. And then so if they turn around and sell it 5 seconds later, they've got no gain period, and they don't even have to reinvest that to create a deferral. They effectively, that deferral that you were kicking down forever and ever and ever, well, it just jacks right back up to fair market value. So you're in good shape.
So you're just not in good shape because your kids might want you to die. Besides that little.
That's right. Don't tell the kids, the whole situation. Some things are better left unsaid.
They're like, any day now, Dad, any day.
Come on, man.
So 1031 is a like-kind exchange. Does that mean you can, I've had a lot of conversations with different people that have steered me in various directions, but can you exchange a residential investment property for a commercial property? Can you exchange residential property for an Airbnb, for land, for what is like, how do you define like-kind?
Sure. So when I said real property earlier, that's what's key. So we're after real property. So anything that can be legally identified as real property can be exchanged for real property. In fact, Matt, you can actually say you sold a single family residence property, and say it was one of your nicer ones, and you have this huge gain on it, and you actually want to buy 2 or 3 houses with it. That's actually allowable as well. So you can actually sell one property for multiple properties, you can exchange one property for multiple properties, or you can exchange multiple properties for a single property too. So really, it's just the key here is real property for real property. So you're right. You've got whether it's residential, commercial, you name it, it all fits in there.
But you can't exchange out of an investment property into a primary residence, for example, can you? Even if it's on a commercial note, or if it's, you have some business activity in that property?
No, great question. So the personal residence is actually where it gets a little bit dicey, and it really just depends on the history of that. So say that you, and I'm not going to get all the way into the weeds here, but say that you owned a property that you rented out for several years, and then you converted it to a personal residence. Well, we just need to know how many years were in there that it was personal residence, how many years was it for business, et cetera, and then what are we exchanging it for? So as long as some of the facts fit, you can exchange, have a personal residence in an exchange. We just have to be real careful on what the facts are. If it was never a business property and it was always a personal residence property, it typically does not qualify. But kind of the benefit to individuals is if you sell your personal property for a gain of less than $500,000, you get a personal home exclusion. Of course, you have to have lived there 2 out of the last 5 years, but you can actually avoid paying tax on up to a $500,000 gain for married filing joint.
That's
so
good.
It's still a pretty good answer.
Yeah. Okay. Let's talk about accelerated depreciation. If we accelerate depreciation in property that's sold, and we'll talk about how we accelerate depreciation in cost segs and all that other stuff in a second. But if we accelerate depreciation in property that's sold, and of course, accelerated depreciation is, one of the main benefits of depreciation, which is one of the main benefits ultimately of owning real estate, and that you're going to save on your taxes today. And, my dad's always saying, stop tying yourself in knots, just pay the tax. And I'm always like, I don't know. I want to save money today and I can worry about tomorrow. But, if we accelerate depreciation in a property that's sold or exchanged into a like-kind exchange, or we use a 1031, what is the implication on the depreciation in the new asset? And as an example, we, in a partnership, bought a property back in 2018. We paid $535,000 for it. It was 28 apartment units. We put in $300,000, and then we sold it in February of this year, 2022, for $1.5 million. So we took $800,000 of proceeds after we had paid down some principal and after we, had the actual gain on the sale, and we recreated the debt and bought probably $3 million worth of assets, bought 10 single family homes, new builds, and our intention is to depreciate that heavily. So if let's leave aside for a moment how we actually do the accelerated depreciation. But if we accelerated the depreciation in the first property and we plan now to accelerate the depreciation in the new 10 properties, like what happens? What are the implications? Can we just, is that kind of a simple thing to do?
Sure. So the big picture when and this is whether it's an exchange or a sale here, whenever you depreciate property and then you sell or exchange it, you have to, up to its original cost basis, you have to recapture that depreciation as income. So that actually comes back through as ordinary income. It's got some special rates, but it comes back through as ordinary income. And that again doesn't even matter if you exchange it or not. So the gain above that. So let's say, Matt, in your example, so you said around 800,000. I'm gonna keep the numbers real simple here. Around 800,000. Let's say you accelerated, $300,000, or let's just say total depreciation was $300,000. So your tax basis in that property would have been $500,000. When you went and sold it for $1.2 million, you've got a $700,000 gain. Well, of that $700,000 gain, the first 300 of that is called depreciation recapture, and that's what you pay the tax on almost no matter what. Very few ways to get out of that. But then the rest of that gain, so that other $400,000, that's going to be taxed at capital gains rate, which that's a preferred rate. It's about half of what the federal ordinary rate is. And then a beautiful thing for you Oklahoma listeners, and there are a few other states that have this, is get capital gains on properties, or really most capital gains generated in Oklahoma, you get an exclusion from paying Oklahoma tax on it. So that's actually a really nice benefit in certain states.
And that's just really an incentive to
requirements, holding periods and things.
But the state government has just said, we want you to invest your capital, and therefore we won't tax your capital gains. In essence, they say that's just a promotion of investment ultimately. Bingo.
Cool. I mean, and for you that are sophisticated with the tax law out there, that is something that's been a question in the House. So if you're looking down the pike here and you're saying, hey, I'm trying to decide, should I sell or not sell, really just keep your finger on the pulse for what they're doing over there.
So then in this example, I've depreciated 800 down to 500. So I owe tax on the $300,000 gain. And then if I exchange the 800,000 of proceeds, then you said we'll use slightly different numbers, but in the actual situation, if I exchange the $800,000 of proceeds, because it's an exchange, I don't pay any tax on that $800,000 of proceeds.
Sure. So on the rest of that gain, the way that works, I'm glad you brought that back up, because I probably didn't close the circle on that side of it. But so let's say now you put it into a new property. So really we're talking about, Matt, is that $400,000 of gain is what we're after. So you have to actually reinvest 100% of the proceeds if you want the gain to be 100% deferred. Mm-hmm. You can do a prorated amount, but then your gain will be prorated as well. So if we invest all of the proceeds into a new property, that $400,000 gain, let's say you bought a $2 million property with that. Well, that $400,000 gain will actually reduce your basis in the new property. So instead of having $2 million to start with, you get 1.6. And that's how you kind of create this little deferral. And then with that, you can still try to identify, okay, I know we haven't gotten to cost segregation yet, but you identify, okay, what pieces can we cost seg out of this so that we can accelerate deductions on this property as well.
So assuming you actually maximize the debt that's allowable on that property, you're ultimately, now that the 400,000 as example has reduced your cost basis, you're ultimately, depreciating off what you've got the debt against and anything else you put into the property. Right. Okay. Interesting.
Well, and what I'd say, I for sure feel like I need to say this, Matt. So when we're talking about exchanges here, guys, if depending on what the cash is that you get out of this and kind of what the exchange of liabilities are, if you end up in a better position from a debt perspective, there's going to be some tax consequences with that. It's called boot. And again, I don't want to get too granular on the podcast here, but if you've got some exchanges where you get a little bit of cash, maybe some of it doesn't go through a qualified intermediary, we certainly want to talk and make sure that how's that going to be taxed?
Right. It's complex for sure.
I'm trying to stay out of the weeds too much.
It makes my brain spin a little bit, but certainly sure. Complex. So if you've done these changes, the other
big debt. Sorry, go ahead.
The other thing is if your cost basis is 1.6 in the example you just gave because of that $400,000 deferral, and you turn around and sell it the next day for 200, you now that's a gain. I mean, now it's just a gain. And if it's a day later, I guess you'd pay short-term capital gains. And if it's a year and a day later, you pay long-term capital gains on that $400,000 that you originally deferred to reduce your basis. So interesting. Let's talk for a second about what owners can do to accelerate their depreciation further. And I guess maybe it's worth talking about what is kind of national regulation and what is Oklahoma specific. There's a bunch of things that we do in Oklahoma that probably aren't valid in other places. But what can owners do to accelerate their depreciation, to maximize the acceleration of their depreciation?
Sure. I think probably the main strategy that you'll see professionals use to accelerate their depreciation is called cost segregation. In short, what that is it's identifying the personal property component of the real estate, and you're pulling that out to separately depreciate that. Under current law, that's 100% deductible in the first year. So personal property that you can depreciate, you can write it all off in the first year. Anything other than that, here's the caveat. Here's why you want to do it. You want to talk to somebody like CCK, is because if you don't pull those pieces out, every single part of your property that's depreciable will be depreciated over almost 40 years. And so that's a really slow depreciation. And when we're talking about ROI and you've got all kinds of investors in and they're trying to decide do they want this deal or not, that tax depreciation is a great way to kind of add the cherry on top for your investors from an ROI perspective. I
mean, but it doesn't make sense. Like the roof, if you don't segregate out the in different components of a house, the windows are gonna actually have a useful life that's different than the HVAC, that's different than the roof, that's different than the paint on the walls. So it's important, I guess, to make sure that the depreciation, even if you don't want to accelerate it, just to identify that if you don't segregate it out, then everything's depreciating at the same rate, and you're really not taking advantage of the disparity between the true life of a component of the house and the depreciable life of that component.
Well, you're spot on, Matt. And not only even if the law, even if you don't need all the deductions and the law changes and maybe it's not 100% depreciable in the first year, that forever since I've been a professional and even well before then, these personal property components, they still have a much shorter life. So let's say this 100% bonus depreciation rule goes away and you can't take advantage of Section 179. Again, I know it's a little bit of foreign out there for some of you, but if you're not able to take advantage of some of that, it's still nice to have property that you'll recover the cost of it over 5 or 7 years versus that 39-year life. Now that's all talking about it from a federal perspective too. I know we've got, with us being in Oklahoma, I know we've got some Oklahoma listeners, so I'll just have one little caveat in there. If you're in Oklahoma, you actually get preferred lives anyways in most parts of Oklahoma. If you're in former Indian reservation land, and this is as identified by the IRS, then your lives are cut in about half. So let's say in my example there, I was just telling you about how a building is depreciated over 39 years. Well, that same building placed in service in these specific parts of Oklahoma, that's now depreciated over 22 years. Those other assets, when I told you, 5 and 7 years, when we're talking about personal property, you can get it over 3 or 4.
Wow.
So it's just, it cuts the lives down in about half, and it's just another little benefit for investment in the state.
Do you need to be in Oklahoma? Can you be a California investor investing in Oklahoma property to take advantage of these accelerated depreciation, the Indian depreciation?
Yep, that's right. It's all about where the property is placed in service.
So on a kind of very broad basis, if I bought a house for $100 and I was doing the cost segregation and and everything was, and we went through every single item in the house, what sort of depreciation would I expect year one of that total $100?
Yeah, no, great question. I'm glad you brought that up. So I've been doing this in the market for a few years here, and we work with engineers when we need to, just so that we're extremely specific about what components can we break out and not, because it is a pretty involved process to really get down into the details of it. But what I've seen, I'd say probably over the last 4 years is about 20 to 30% of the
Wow.
acquisition price is what you can pull out and depreciate in that first year. Now, of course, we're taking out the land first. So land, if you guys don't know, land is not depreciable at all. So we have to pull out whatever the land's value is first. But then that remaining amount of depreciable property, that's typically when I can see us get around that 20, 25, 30% in the best cases. I've not quite ever seen anything over 30%. I'm not even sure if I've hit 30. So it's normally in those 20%.
I mean, so in this deal that we did, the exchange recently, forget for a moment that there's some, cost basis to the exercise you did before. But if we're buying $3.2 million of assets, maybe 10% of that is land value. And then if we depreciate that 25% in the first year, that's $720,000 of depreciation year one. I mean, that in itself takes care of, the tax liability. Reduces the tax liability to such an extent that it makes the deal worthwhile, even with no cash flow, no principal depreciate, no principal, pay down, no appreciation, the whole deal. I mean, it's just crazy what that can do for your tax liability.
You're spot on. I mean, it even more so for those that can deduct those losses. I mean, you may have somebody like we said earlier, who's just a W-2 guy. Maybe they're a doctor and they just want to invest in something. They care about the long-term holdup, but they may not see the same value in something like a cost segregation. But many of your, many investors are sophisticated and they're doing this not just on a one-off basis, and that they want to take advantage of those losses. So it really is a great tool.
I mean, but even if you're a doctor making, I don't know what doctors make, $500,000, $1 million, and you've been, earning that for 15 or 20 years, you presumably have put all that cash away into a 401k, or you've put it into into the stock market. And now you've got, a pretty sizable chunk of cash that's probably producing good dividends. And when you sell good earnings, or good, I don't know what you call that, good, whatever happens when you sell stock, like gains, that you should be able to take a bunch of that. You actually should be able to take advantage of a bunch of that now passive in this scenario, loss against, passive gains from your stock market portfolio. So I think still very valuable, but certainly not. I mean, as I said, I'm in the holy grail situation where you're an active real estate professional or whatever the thing is, and you're, therefore taking active losses against active gains. Anything else that we should cover while I've got you on the pod?
Yeah, probably just a couple of quick things I just want to point out, since I'm not sure that I said them earlier. Whenever you're looking at a 1031 exchange, there are two dates that you really need to keep in mind. The first one is you've got 45 days from the day that you sell the property to identify in writing the property you're going to exchange it for. Keep in mind that your funds also have to go through a qualified intermediary. If you sell a piece of property and it hits your bank account, we're in trouble. Doesn't mean we can't get around it. We've got to get with the qualified intermediary and still try to fix some things. But really, it's just best if it goes straight to a qualified intermediary. You let the qualified intermediary know that, hey, within 45 days, I've identified this property. You have to write them a letter, send it to them. And then the second piece of that is 180 days after you sell the first piece of property, that's when you need to be closing on the second piece. So that gets a little, 180 days, that's half a year. And so as you can see, there could be several situations where you sell a property in 1 year and you buy a property in another year. And that deferred gain gets a little bit wonky because you've got, a gain in 1 year that you're trying to kick out for perpetuity. So certainly there's some nuances there that you want to be mindful of. And then kind of the flip side of this that I wanted to make sure I bring up is you can also do what's called a reverse 1031 exchange. That's actually where you buy a piece of property before you sold one. You need to keep in mind that you've got the same days threshold on that side. So if you buy a piece of property within 45 days, you need to let the qualified intermediary know that you're planning on selling which property, and then within 180 days, you've got to sell that property. And so that's how we can still qualify for a reverse 1031 exchange, which is it's pretty complicated, but you can do it.
But that's super interesting. So if you the 1031 is so constrictive in terms of timelines that oftentimes you're forced to sell a property or you're forced to buy a property because of the timeline. So that's interesting. The reverse 1031 exchange, you can actually do it in reverse order, and then it frees up some of your possibilities. So if you see something that's a really good opportunity, you're like, boom, let's jump on it, and then you figure out on the back end what you want to sell to capture the gain that's necessary to exchange ultimately. That's good
right.
stuff.
That's right.
Anything else? And I should mention, we have historically used two qualified intermediaries. We've used Darren Fox at First Title, and we've also used Megan Arnold at Oklahoma Title and Escrow Corp. I think they've changed their name now to Community Title, and they're both awesome, great. Maybe I'd like to ask one of them to be on the podcast so we can talk a little bit about all the craziness. And if you're not from Oklahoma and you're not from a state that does abstracts, it's a very archaic situation where you actually go to a physical location, pull the abstract, which is a book that's hidden in some chamber somewhere, and an attorney reads the title, reads the abstract to make sure that there's continuous title and there's no gaps, and then they update the title with the new deed, and it's crazy. I don't know the full ins and outs of it. They're only held a couple of different places in town, but so maybe one of them can come on and exchange and describe the entirety of that process. Caleb, anything we missed? Anything else that we should cover?
I don't think so, Matt. I mean, I would just say some of the topics that we discussed today are extremely complex and nuanced. And so just make sure you're getting professional advice. I mean, whether it's me or someone else, preferably me, then just make sure you're getting professional advice. I'd hate to see someone mess something up because they just took some of this general information and ran with it. Right. Just make sure you're getting advice. That'd be my last piece.
If somebody does want to get in touch with you to handle some of these nuances and these complexities, how do they do it?
Sure. I mean, a couple of different ways. I mean, my email is Caleb, CALEB at cckcpa.com. My phone number is 918-491-4036. That should get you guys straight to me. Like Matt said, I answer the phone. Unfortunately I answer way too many text messages sometimes, but I'm cool. I love what I do. I love working with people like Matt. I love working with entrepreneurs, other people who are out there hustling the same way I am. And so it's a lot of fun. So feel free to reach out. First consultation, always free.
I love it. Caleb Caldwell is a partner at CCK Strategies, public accounting firm. He works with entrepreneurs all over the United States and across multiple jurisdictions globally. So reach out. He's got a ton of information. He's a wealth of knowledge, and he's been super, super helpful to both Keyrenter and our family. So I appreciate that, Caleb, and I appreciate you being on.
Love it, Matt. Thanks for having me. Appreciate it.
Take care.
Thanks for listening to the Same Day Podcast. Tune in to a new show each week and be sure to subscribe to get future episodes.